back to Brashenomics. I'm Ben Brashen, and we are here with Ryan Leopold from Cobalt Mortgage. And, a lot of people, I think everybody would like to save money on their mortgage. Some people don't want to go through the steps. And if they do save money on their mortgage, well, they can go fill those big baskets at Whole Foods with just 40% more stuff and maybe feel a little bit better about it. Ryan, this time of year, there's some changes in the mortgage industry that maybe aren't quite publicized as much, and the reason rates fluctuate. You got big plans for the holidays other than monitoring mortgage rates, or what?
That's exactly what I'm doing the entire Christmas holiday, is keeping an eye on interest rates to make sure that refinances and purchases go off without a hitch. Absolutely.
I love it. Well, as you do get into the holidays, it is a different time of year, and there's some reasons that rates fluctuate that really aren't market driven, which is different than other times of the year.
It's interesting for the consumer to understand that rates fluctuate mostly, I'd say 95% of the time is based on market conditions, general market conditions, and those change every single day exactly like the stock market does, in the same kind of, they can change hour by hour and minute by minute. But there's a little known side of things that are that most consumers don't know about, is that lenders have the ability, and they do often, not only during the holiday season, but at other times of the year, they fluctuate interest rates really to balance out capacity because of just, for the sake of capacity, because there's only a certain amount of manpower they have to help loans throughout the process. So if they're just flat out too busy, or especially during the holidays, a lot of lenders will increase interest rates a little bit to stop the flow of business coming in,
really
to get through the pipeline that's already there.
Really artificially raise interest rates in order to deter new business.
Exactly. Yeah, so that happens, it happens throughout the year at different periods of time, but especially during the holidays. And again, this is not every lender across the board, but you got to understand it does happen that you're going to have a week or two before Christmas, those loans that need to close before Christmas and New Year's, they have to get done. If you start having a flood of new refinances or new purchases come in during that period of time, it really hampers their ability to close the stuff that's already in the pipeline, with half the industry tending to take that time for vacations. And we're talking about understanding how many people are involved in the mortgage process and how many people take vacations during Thanksgiving, Christmas, New Year's, everything. It's just the natural flow of things.
Sure.
And not every lender practices this. It's going to be a variation, but it happens a little bit more during the holidays as opposed to not.
And you talk about capacity and the amount of people. You think about the amount of people who are involved in a transaction, whether it's a real estate agent, a loan officer, a processor, an underwriter, somebody who's putting the docs together, somebody who's going to help you sign the paperwork, somebody who's going to fund the loan, all these different pieces of the puzzle. And if one of those people go on vacation and everybody knows who's working, you have your little work buddy who tries to cover your other stuff for you. Now they have twice as much on their plate. So things just slow down naturally. And that's, again, why those rates can go up, because they can't handle more business.
And it really is. So you take the fact that you have so many people involved in the transaction and so many people gone during the holidays, and then you couple that with the lowest interest rates pretty much have ever been, and the tightest mortgage guidelines they've ever been, that just makes this time of year a lot more susceptible to those price fluctuations. And so really, at the end of the day, the best advice that I can give to people looking to refinance or looking to buy a house is just work with a lender who knows the market and can follow it every single day, because you're going to have these fluctuations where a good lender is going to know, hey, this is what the market is. This is what the different lender has increased to because of this. And let's find a lender who's going to be more on par with the market. And we're not talking huge fluctuations. We're talking enough that would sway a consumer to go to lender B as opposed to lender A. But most lenders that are not captive like at the big banks, us, for example, we can shop it around to multiple different lenders. So if one lender can't do it, or it's not the most competitive on any given day, we can go to a different lender who maybe isn't practicing this capacity issue, artificial rate increase.
Sure. Now, we're here with Ryan Leopold, the Cobalt Mortgage. Ryan, just have a couple minutes left. But the other thing that can raise rates that may appear to be artificial is the fact that when things take longer, you have to lock a loan longer, right? And some people may not understand what a loan lock is, but why don't you go ahead and explain that what a lock is and what it means if you have to lock for longer periods of time.
Good question, Ben. So if you start refinances are a little bit easier to explain because a purchase, you kind of have a finite time that it has to close in. A contract closes in 30 days. You're going to lock an interest rate in for 30 days. And from the consumer standpoint, that basically means that you're guaranteed that interest rate that's not going to go up during that period of time from the day you lock it to the day you close.
Sometimes 30 days, sometimes 45 days, sometimes 60 days.
And what's a little bit more interesting on the refinance, there never is a defining point where that refinance has to close. So when you're locking it in for 30 days as opposed to 60 days, that just means that a lender is going to assume it's going to take, because of capacity issues, maybe 60 days to close that refinance as opposed to 30, and the cost of locking it in for a longer period of time by having that guaranteed provision in there is just cost the consumer more money. So as more capacity goes up, the cost of that loan is going to go up, and in some cases, the interest rate's going to go up a little bit. So you kind of want to find a lender who is going to watch interest rates for you and watch the market and kind of get what's going on, who's going to get your loan through on a refinance or a purchase as smoothly and uneventfully as possible, and really just disclose to you kind of the nature of where you are and what it's going to set proper expectations as far as close times, lock periods, interest rates, fees, etc.
Sure, and I think, just knowing that you may have to lock a loan for a longer period of time, therefore costing you more money during the holidays, in some ways, if you trust the markets to stay low or rates to stay low, would be a reason to wait.
Mm-hmm.
I mean, there is a reason to wait till after the new year because you might need a 60-day lock going into the holiday season rather than maybe a 30. Ryan, we do have to go to break. Thanks so much for joining us. Again, Ryan Leopold with Cobalt Mortgage. When we come back, there's a little song that's going to be sung by Heather Moore. We'll be right back after this break.